So reporting season really was all about taking costs out of business. And if you look at the companies and how they've delivered results, it was all about taking costs out of the business. Revenue growth was very weak. Across the group of companies that reported, revenue growth was only up 0.5%. Once you take out resources, only up 3%. So it was all about cost out. And what we've seen also is investors become more optimistic around the market and growth expectations for EPS moving forward. So the market PE has actually expanded to 14.9x resources versus an average over the last 10 years of 14.3. If we want to break it down a little bit more, particular sectors, the banking sector, a big sector, delivered very strong results, really highlighted by lower funding costs, better credit quality. The market, rewarded them for those results. Having said that, we think that they're actually expensive at these levels. CBA 14.5 times PE, 2.5 times book, 5.5% fully franked yield. Yeah, it looks good to cash, but for us, we see longer term opportunities elsewhere. The resource companies, the big Rio and BHP in particular, have seen a changing of the guard of the CEOs there. And what we've actually seen there is a focus on cost, capital allocation discipline, which is very interesting from the new CEOs, and no focus or less focus on growth. So opportunities that may fall out of there. On the short side, we think mining services, investment in mining has peaked in our view, and that would be something that we're looking on the short side, mining services. In terms of the long side in general, we're finding it a little bit tough to actually find opportunities. As we said, the market PE has expanded and fundamentals in our view need to catch up for some particular sectors before we actually dip the toe in the water again.